You can hear me okay? Toda, Shalom, Maccabi Tel Aviv, Toha. Now the only 4 words I know in Hebrew. And actually I think that Avi and Nathan and Moti and Oren and Avital, I think they like it that way actually. Sometimes when they're in our boardroom in Soho in London and they break out into Ivrit at 2,000 miles an hour, after a few minutes they'll break off and they'll say, "You don't speak Hebrew?" "No, I do speak Hebrew." None of us speak Hebrew. They're like, "Okay, cool, that's good." So we're not going to learn. Anyway, thank you, and thank you for giving us the opportunity to present our company this morning. The presentation is in 2 parts today. The first part is to talk about the macro, and in particular the disconnect between the top-down at the moment in the UK, which is volatile, populist, quite likely to be economically damaging to some degree, depending on the detail regarding Brexit, as against the bottom-up, the real estate fundamentals, which are solid, they're sensible, they're well protected, and at the moment there are no visible warning signs in the commercial real estate market in the UK, particularly in the London office market, other than Brexit itself, and we'll come on to that. So I'll explain this graph a little bit, and this is our graph. This is we are the source. Brockton Everlast is the source for a lot of this material. How do things feel in London right now out of 10? Politically, pick your number. It's somewhere between a 1, 2, and a 3. I mean, it's pretty bad right now. We're probably at the moment of maximum uncertainty. Theresa May, the current Prime Minister, has quit. She decided not to go immediately because Donald Trump arrives today. Not that that's going to be controversial, or that is very likely to throw the cat amongst the pigeons after his 72 hours in the UK. We have a Conservative leadership contest. There'll be more about that later. Economically, though, despite the political volatility, things are not too bad. The economy did not collapse after the Brexit vote. We still have a positive nominal and a positive real GDP growth story in the UK. And economically, we'll come on to some of the reasons why that is. In commercial real estate, particularly in London office, things are relatively solid. There's a number of reasons for that. After the Brexit referendum vote in June 2016, a lot of developers stopped building. The cranes fell silent, and as a result, there is very low supply of commercial office space in London at the moment, which is very positive. Counterintuitively, take-up has remained strong, particularly amongst tech, and even financial services has not shed the amount of jobs that people predicted immediately after the vote. So commercial real estate is perhaps a 7 or 7.5 out of 10 in the London office market. And business sentiment finally probably sits somewhere, wider business sentiment that is, not real estate, probably sits somewhere between the political sentiment and the economic sentiment. So it's not great right now. So the macro we'll discuss quite a bit this morning. The second part of the presentation is a brief introduction to Brockton Everlast. And the reason this section is quite a bit shorter than the presentations we've seen this morning from Ollie and from Giacomo is because Brockton Everlast has only just started. We've been capitalized for around 1 year. We've only bought 3 buildings so far compared to hundreds and hundreds between Amot and Carr and PSP. Obviously, we're delighted with all 3 that we have bought and acquired, and we'll talk a little bit about them later. But I think as in the early stages of Brockton Everlast, a lot of the emphasis this morning will be on the macro and the London office environment and why we're bullish on London despite the headwinds. Very brief introduction to GDP. As everyone knows, I'm sure there's 1 or 2 economists and amateur economists in the room. GDP stands for globalists, dictators, and populists. Around 40% of the entire global GDP is made up of the US and China alone. And here on this chart, you've got two globalists, two dictators, two populists, except one of the dictators, Xi, is also a globalist, and one of the populists, Donald, secretly wishes he could be a dictator. 4% global GDP growth was predicted last year. When we wrote this original slide for the Brockton LP conference deck last October, most of the macro was pointing towards about a 4% global GDP growth in 2019. But that is being clipped day by day by issues ranging from the South China Seas to Huawei to the initial run-up to the presidential elections. And it's, the trade wars are definitely having an effect. In the West, so in Europe and in the United States, it seems like the middle class has some kind of appetite for destruction, the so-called hollowing out of our middle class in the West. The middle class in the West has been characterized since the global financial crisis in 2007-08 by stagnant wage growth and job insecurity. And as a result of that, you get a lot of populist pandering that seeks to exploit the divisions between citizens instead of bringing them together. And Tom Friedman, who some of you may know, was the Middle East correspondent in the New York Times, wrote a classic book, From Beirut to Jerusalem. He writes about this hollowing out of the middle class, perhaps best amongst many commentators. And one could get fairly depressed if one thinks about that giant middle class cohort in Europe, in the UK, and in the US that is under such pressure on so many levels. Nevertheless, you have to wait because it's not all bad news. In the East, the middle class does not have an appetite for destruction. It has an appetite for Samsung and Adidas and BMW. And look at some of these statistics. This is possibly one of the most powerful statistics that we've seen at Brockton almost anywhere, which is comparing the global population to the estimated size of the middle class. These are Brookings Institute figures. And you can see there, over the next 10 years or so, that the size of the global middle class goes from around 40% of the entire planet to nearly 2/3 of the entire planet. And that's having a huge effect in the capital markets, particularly in real estate, as the search for yield goes on, with aging populations, wealthier populations, people saving more for retirement, and the search for yield. So that's a very positive backdrop, macro backdrop. And finally, on the macro, again, this is a chart that we use in our LP conference every year. We plot the UK, still the 5th largest economy on the planet, tied equal with France, against the other major economies, and look at the respective growth rates. We'll talk quite a bit about Brexit shortly, but there's a quote here from Neil Ferguson, very preeminent historian, was at Oxford University, then Harvard, now Stanford. And he basically is saying that even though he was for Remain, he does nevertheless see fundamental contradictions within the European project. And it might just be, this is him talking literally a few weeks ago on CNBC. He was saying it might just be that Britain leaving the EU is akin to getting a divorce and then your ex-wife drops dead the next month. Because he sees these fundamental contradictions in Europe as being unresolved and perhaps incapable of being resolved by Europe. And so whilst there are many, many headwinds with Brexit, it's possible that leaving the European project early, having not joined the euro, nevertheless being in the EU, but not within the single currency, might just turn out to be a prescient state of affairs for the UK. Call this slide "Who Wins?" between the top down and the bottom up. Is it the Brexit fundamentalists who want to push for a hard Brexit? That means no deal, leaving Europe without any kind of transition period for goods and services, hoping and thinking that Europe will come back to the UK and ask for one almost immediately afterwards? So who wins, the Brexit fundamentalists or the London office fundamentals? The bad news is politics in the UK is a mess right now. Theresa May there on the right has quit. She'll physically leave 10 Downing Street probably by the middle to the end of July. This guy, he's had a haircut since then. He's trying to clean up his image. Boris Johnson is the current front runner. Richard, Selby and I have met Boris probably 3 times over the last 5 or 6 years because he was previously a 2-term mayor of London, and so he had zoning or planning as one of his key policy areas. And Richard and I have had lunch with him in his office in City Hall. We've met him twice on particular planning applications for developments that we're doing in Brockton. And I think if we were going to point to any positives as it relates to Boris, it's that he is definitely surrounds himself with people who he trusts and he relies on them. So I think a key part of the potential next Prime Minister's agenda will be dependent upon who he surrounds himself with, and hopefully he'll be surrounding himself with sensible people who are not pandering to the populists on the far right. By the way, it's not guaranteed that Boris Johnson becomes Prime Minister. There are, actually, Abby mentioned 11 Conservative Party candidates. That was the figure last week. There's now 13. So it's a very crowded, complicated field, and the math will bounce around over the next few weeks. And he's not guaranteed, but he is the likely next leader. The good news, certainly as it relates to the London office market, is the economy is in reasonable shape. And there is very low vacancy, there is low development pipeline, there is strong take-up within the London office market, which we'll come on to. So what's the net result from our perspective as investors in the London property market? Well, you've got things like this going on. So this building, if people know London well, they might recognize it. This is an aerial shot of a building on Savile Row in the heart of the West End. And this building, I put this building up here now because it is under contract now to be sold for what will be a record price per square foot, a record capital value of about £2,800 a foot. That will be a record high for a major London office building. And it just shows you that rents have held up and that the weight of money is still there for very prime assets in London, despite the chaos. The top down, as we've discussed, we have broken politics, we've got fragile economics, we've got a volatile society, and there is a giant void in the centre ground where perhaps 50% of the voters right now almost feel homeless. They don't feel like they have a party or a leader that they can vote for. There is this giant void. Right now, nobody has filled it sufficiently. I would put a plea out to Americans in the room, Ollie and your colleagues, if you guys don't want Mike Bloomberg as president, you can send him over to the UK. We'll make him an honorary Brit, and he could run for Prime Minister. I'm sure he would do very well in the polls. But remember, as bad as the outlook is for the UK politically, the economy has not collapsed. It has underperformed its peers in the developed world. It's currently underperforming most of the economies in Europe right now. And it has stuttered, but it did not go negative. And we haven't seen a recession, even a brief one, since the Brexit vote. So the top down is fairly ugly. The bottom up, counterintuitively, perhaps slightly weirdly, is fairly pretty right now. Both cranes and capital, the two sort of euphemisms we use to describe supply and demand and weight of money for assets, cranes and capital are both in check with good, strong fundamentals. Vacancy rates are low, speculative development very, very low, pre-leasing now a trend that takes the risk out of the development pipeline increasingly. That's very common. The millennial generation have an insistence on working somewhere exciting, interesting, in a part of town they want to be in, and that's creating jealousy in a good way amongst occupiers who are forcing themselves to move to better quality space in order to be able to hire the right kind of talent within their businesses. We have QE-induced virtually flat interest rates that have made London office investments look very interesting and attractive compared to other avenues of return, and debt remains under control. In the US, our understanding is that the capital markets are quite frothy in certain parts of the market, whereas in the UK, you can still only borrow around 60-65% senior loan. You can get some mezz on top of that, but it will be appropriately priced. But generally speaking, the banks are in prudent money good loan making mode, and so there isn't too much debt in the real estate market. The economy, comparing the economy now across the Eurozone and the US, it looks way better than most people predicted. And we'll come on to the London economy later. The nation is levered at a corporate level, at a government level, and at a household level. And this is why QE is so crucial in maintaining the economic story. So there's a lot of things going on here. Ignore this. The green, I think, is US GDP, so ignore that. Just look at these numbers. This is the percentage of government, household, and consumer debt relative to GDP. The UK is still very, very highly levered, and so zero interest rates, or near zero interest rates across most of the central banks is pretty crucial to maintaining the stability of the economy. This slide looks at jobs. These are jobs created since the Brexit vote. These are net jobs created across 5 or 6 crucial sectors in the UK economy. We have a record low unemployment rate in the UK of sub 4%. There have been major job gains made since the Brexit vote, and the only major sector in the UK that has seen job losses is in retail. And for that, I think you could hardly necessarily blame Brexit alone. You should be blaming Jeff Bezos for that particular blue line. But all the other major sectors of the economy have been creating jobs. 85% of the UK economy is on this page, with these the big five major sectors. And I won't run through those big 5 major sectors. You can see there in the green what percentage they make up of the UK economy. But that image on the left is fairly indicative of what's going on in the UK economy. It's the big building in the middle there is the new Google headquarters at King's Cross, which is under construction. The building on the right, you can just see the curved outline or entrance to it. That's the new King's Cross station. So there's been a lot of infrastructure spending in London and the UK, which we'll come on to. There's a new office district at King's Cross that's filled with tech companies, with French corporates taking advantage of its proximity to the Eurostar, design schools, student housing, and Facebook only a couple of weeks ago have leased another 600,000 feet in this part of town for their further expansion in London. The long-run geopolitical backdrop to what's going on in Britain right now, going back, maybe 50, 60, 70 years, but the major themes over the last 30, 40 years, you've had the fall of inflation, starting with Paul Volcker campaign against inflation in the early 1980s in the States. You had the fall of the Berlin Wall in 1989. Then you had the financial crisis, and then the fall in real wages for the middle class. And now, if you come on to today's narrative, you have a fall of the truth in media, and you have a fall in standards in political office. And that's a very unstable backdrop to the politics in the UK, as it is in many countries. This is obviously the continuing ongoing riots in Paris, which have been going on for months. I hope there's no riots in London this week, but it's possible. Some estimates think there's about 500,000 people will be protesting on the streets against Donald Trump in the next few days in London and in other major cities around the UK. This is the EU construct on a single page with the economies sized by size and then the various European institutions mapped out as well. So anyone who thinks that a sensible unpicking of the UK is an easy thing to do with simplistic solutions only is got to be dreaming. And And this is where business in the UK would ideally like to end up. They'd like to end up in a Norwegian, Swiss, loose arrangement with Europe on goods and services, but that feels pretty far from the political narrative right now as we currently head towards the 31st of October exit date, which we'll come on to shortly. There's a lot of right-wing populist parties in Europe right now. The UK has its own version, led by this guy, Nigel Farage. He's a very controversial character. Whether you like him or not, he is a formidable campaigner. He is incredibly articulate, whether you think he tells the truth or whether you think he is dog whistling in many cases to the far right and to people's prejudices. Either way, he certainly is clear and has conviction, and he runs circles around many of the middle ground politicians in the UK right now. And so this is a backdrop to the current leadership contest for to be the next Prime Minister and leader of the Conservative Party. Right now, many people in the UK think that the politicians are acting like clowns. It's about the only image I could think of right now for what's going on in the Houses of Parliament. And I think that by the summer, hopefully, we'll have some kind of leadership again within the government from someone who has conviction on which way the country needs to go. And hopefully they'll be forced by the markets and by business and the reality of a reasonably strong economy with strong employment towards a much more business-friendly relationship with Europe. Inequality, I think this chart, Ollie could have perhaps put up this chart to an extent. I think there's many countries, perhaps not in Switzerland, but there's many countries in Europe that could also have put up a similar chart to this. Quantitative easing did not effectively transmit that capital to the average household in the UK or elsewhere. Interest rates may have stayed low, but that's of no use if the banks are not lending sufficiently to startups and to small and medium-sized businesses in order to generate further economic growth. And the inequality, as you can see here, is multifaceted, both in Europe and the United States. Finally here, this is the political menu across many countries around the world. I guess it's a question, it's almost like walking into a restaurant and the waiter says to you, "How do you like your steak cooked, sir?" And I think this chart is basically saying, "How do you like your state cooked, sir? Do you like it far right? Do you like it far left? Do you like it populist? Do you like it reformist? No, you prefer centrist. You want to be here. You want to be in the centre. You want to be reformist. I'm sorry, sir, that's not on the menu today. It's not really on the menu anywhere." And I think the hope, if there is any, for the UK, is that Johnson, if he is the front runner, moves further to the centre, assuming he takes power, and sees off the threat of Jeremy Corbyn, which Avi mentioned earlier as the hard left Labour socialist leader. Finally, on sterling. So this is sterling over the last 3 years since the Brexit vote. The sterling is the indicator of sentiment towards Brexit. The gilt market is no longer an indicator of investor nervousness to the extent that it's been flattered and flattened by QE being a central bank policy measure. So you can't really look to the gilt market necessarily for sentiment. You certainly can't look to the stock market. 70% of the revenues in the FTSE 100 in the UK are made up of international revenues, overseas revenues. And so the stock market is almost disconnected itself from the wider UK economy, certainly the FTSE 100. So the real barometer of sentiment is really sterling. And it's currently touching around 126 today. This is the timetable over the next few months. As I said, Trump's here now, back in London. The 7th of June, Theresa May effectively steps down, although she'll stay in 10 Downing Street probably till around the end of July, when we'll have a new Conservative Party leader and hence a new Prime Minister without the need for a general election, without the need. And then by the 31st of October, we are due to leave Europe either with or without a deal. And this current government, in its current format, can hang on until May 2022, until there is the next general election. But anything could happen. You could have a no confidence vote, or Boris Johnson, if he is the next leader, could try and increase his majority by calling an election and trying to beat Corbyn more comprehensively this time than Theresa May did a few years ago. So that's the political and the FX backdrop to what's going on right now. Come on to now our world, which is the UK property market, and where the fundamentals remain very strong in London office. So this chart really just explains the fact, very simply, that the UK is a very small country. It's about the same size as the state of Oregon. Imagine the state of Oregon, if you can imagine that little state in the top left-hand corner of the United States. Imagine Oregon with 66 million people in it, nearly 40 million annual visitors a year on top of those 66 million people. And imagine the state of Oregon was the 5th largest economy in the world, where zoning or planning was really tough and construction costs were high. That's basically what the UK is. It's a small island, it's a big economy, it's a big-ish population, it's got incredibly tough zoning, and that equals expensive real estate for many reasons. This is our sandpit. This is Brockton's sandpit. I'll explain just what's going on here. So this is the total value of all commercial real estate throughout the whole of the UK. You call it just under £1 trillion of commercial real estate, but only half of it is investable. Just under 500 billion is actually owned by third-party investors. The rest of it is various other. It's owner-occupied supermarkets. I know Mott have a lot of supermarkets. Most of the supermarkets in the UK are still owned by Tesco, Sainsbury's, Asda, the big supermarket operators. Includes government office buildings, local authority office buildings, university campuses. All that kind of stuff is not really investable because it's still owned and occupied by these kind of large corporate or government entities. So £500 billion is the investable universe, of which 250 billion is owned by third-party investors in London. So this is sort of the Brockton sandpit in which we're now investing. The reason I put the size of the residential market on the other side is because it's relevant, because unlike in the United States, we have a huge amount of investment into multifamily housing. Within the nearly £6 trillion worth of housing in the UK, about 1 trillion is the PRS, the private rented sector, of which virtually all of it is owned by moms and pops. It's just an incredible long tail of 1 or 2 apartments owned by people effectively investing as their own pension, perhaps buying their kid an apartment for college, and that's it. And the institutional investment in the PRS sector is minuscule. And what that means is that all that institutional money that wants to get into the private rented sector but can't because of planning reasons or ultra-low yield reasons and regulatory reasons is forced into the commercial sector. And not only is it forced into the commercial sector, but retail real estate right now is seen as a very risky bet. Not many institutions want to make that bet in the UK right now. So that's forcing more and more capital into office and industrial, which we'll come on to, which is where you've got the weight of money argument for London still very much in effect. So these are long-run returns over the last 12 years or so. This is commercial real estate total return, so income plus rental growth plus any capital value growth, i.e. yield shift or otherwise, on an unlevered basis over the last 12 years. Obviously a lot of volatility around 07, 08, 09, but the long-run average, the simple average here, is around 6.5% total return in the UK. Put up this photograph here as an example of Brexit volatility in Brockton Capital Fund 3, which Alony Hetz are investors in. Just after the Brexit vote, we got a phone call from a retail fund manager. So this is an institution in the UK who are selling smallish units to mom and pop type investors. They had a lot of redemptions after the Brexit vote. They weren't holding enough cash, despite the regulator and the Bank of England asking them to hold enough cash ahead of the Brexit vote. They needed to redeem. They needed to allow the investors to get redeemed and to pay them out in cash. And they panicked because they had complete illiquidity within their portfolio. We had a phone call from an institution. I remember we took that call on a Monday evening. They said, could you buy this building? It's in Hammersmith, in a good location. This is the tube station in Hammersmith. There's 4 or 5 tube lines here, right next door. This is a brand new office building, completed about 2 years ago. It was 100% leased with around 10 years of WALT, 10 years of average income, to a widespread of credit tenants at market, actually below market rents. They said this building's worth about £100 million. Can you buy it in 5 days? Not 5 days, exchange contracts, put down a deposit, complete 3 months later, subject to financing, 5 days, £100 million. We said, no problem. But it's not £100 million because there's uncertainty in the market with Brexit. So we'll pay you 83. He went, don't be ridiculous, it's not worth 80. It's worth £100 million. It was worth £100 million last week. We can't sell it for 83, but we've had a bid at 95, so forget it, Brockton. We said, fine. They went under contract at 95 million to another UK institution whose investment committee said, forget it, there's too much uncertainty. I know we've got the contract, but we're not doing it. The investment committee turned them down at 95. So now the institution came back to us. There's now 4 days in which they've got to get this completed. And they said, you've got to pay more than 83. And we said, fine, pay 84. And 4 days later, we bought it for 84 million. We were intending to hold it for the long term, but then someone made us a proposal a couple of months later, and we sold it for 104. 3 months later. So it's a good example. We didn't perceive we were taking that much risk at the asset level because it's a very well located, brand new Class A building, 100% leased to great credit tenants. We didn't think there was that much risk. But when you have the political volatility, these kind of situations can occur. And we have seen similar-ish moments of this happening over the last 3 years as investors get slightly out of whack with their liquidity. And that's what we seek to take advantage of now going forward in Brockton Everlast. Do we see much risk of a correction in the London office market? So these are metrics that we look at. We look at oversupply. Question mark, you don't have it. We look at leverage. Is there too much leverage in the system? You don't have it right now. In the UK, is there a banking crisis? No. Is there a global financial crisis? No, there's a trade war, but there isn't a global financial crisis. Has there been a material recession in the UK, even since the Brexit vote? No. The UK economy is underperforming. It's not doing great, in the mid-1%, but there is no recession. So what is it that could trigger some kind of correction in the real estate market? And it's, in our view, it could be the political chaos that follows in the result of a potential no-deal Brexit. So that's a question mark. So most of the classic pointers towards a correction in the UK right now are not pointing to the correction, but we do have to watch very carefully what's going on with the politics. Coming on now to the London economy. London is the incumbent heavyweight champion of European cities. If you're a challenger city in Europe and you want those belts from the heavyweight champion, you have to knock him out. You have to look at London compared to the US, and you can see the concentration of all the industries and sectors and government that is all focused in London. Everything is right now focused in London in the UK. That's not necessarily a good thing for the UK economy. It hasn't created much wealth creation outside of London and the wider southeast. But we're not politicians, we're not economists, we're investors. So we're investing in London, where you have the growth, where you have the job growth, and where you have those compounding growth in rents, and where you have the liquidity. How big is the London economy? Well, including the wider southeast metro area, if you like, in US parlance, you'd call this the Greater London metro area, is around 700 billion pounds worth of GDP every year. The Greater London metro area, its economy is around the same size as Hong Kong's and Malaysia's and Chile's all combined. That's how big London would be. It would be around number 16 or 17 in global league table rankings. So it's a very large and diversified economic area. Again, a counterintuitive chart. I won't run through this, it's quite a complicated chart. This was put together by Green Street Advisors. But this looks at the number of job relocations out of financial services since the Brexit vote. And the projections keep getting revised downwards, downwards and downwards. There were huge projections that there could be up to 75,000 jobs lost out of the 500,000 jobs in total in financial services in London. And people said 75,000 jobs could go as a result of Brexit. So far, they've been recorded around 4,000 only, and the worst case projections are for around 20,000 jobs over the next 5 years. That's in a worst case scenario. The reality is that the investment banks and the peripheral service providers around financial services do not want to move jobs anywhere unless they absolutely have to. And so all those jobs, those job losses are being lowered month on month. By the way, 4,000 job losses, 4,000 job losses is equal to what Facebook just have decided to hire in London, just Facebook alone in the last few months. Coming on to the big tech occupiers, Google, Apple, Facebook and Amazon have all been creating jobs and leasing big blocks of office space in London over the last couple of years since the Brexit vote. As far as tech is concerned, they've hardly blinked as a result of Brexit. We've now got the rise of the million square foot tech occupiers. Historically in London, the only firms who occupied 1 million feet other than the government were the big investment banks. But you can see there's a chart here where we're showing the rise of the million square foot tech occupier. And that's been very, very positive in terms of the economy, rents, pre-lease construction, etc. It's been a very, very positive story since Brexit. Deutsche Bank and JP Morgan, as an example, took around 40 years to grow in London to be million square foot occupiers. A lot of these firms have done this in 5 to 7 years. And so it's been incredibly positive for the market. Vacancy is below the long run average across the city and the West End, which is the key markets. Take-up, again counterintuitively, has been above the long-run average. This is gross take-up in London, has been above the long-run average for the 3 years since the Brexit vote. And this has been very positive. Co-working is a significant proportion of current take-up. It's around somewhere between 15 and 20% per year. But this is... Fora is the Brockton Capital Fund 3 owned co-working business. It has a slightly different model to a lot of the other co-working providers. We own the vast majority of the buildings, unlike WeWork and Regis and others who lease them. But I can tell you that between the 15 and 20% of take-up in London that has been taken by these co-working providers, they are virtually all full. Anyone in the Brockton team can barely walk past the co-working operator in London without popping in, whether it's for 2 minutes, 3 minutes, or a very quick tour for half an hour. We're always popping in, and we can tell you that these buildings are 90% plus full. So co-working has been a very strong trend in London over the last few years. Rents. These are rents across the 19 sub-markets in London. Interestingly, the city core, this is the area around the Bank of England, rents there have now been overtaken. You can see there Shoreditch, north of the city core, has rents higher than the prime CBD, the historic CBD in the financial district. And that's because many people, including crucially the millennial generation, couldn't care less about an office's proximity to the Bank of England. So we put a photograph here of a swimming pool in Miami, which is actually in Shoreditch. So this is the financial district. You can see the towers of the financial district behind here. And these are the kind of mix of uses that are going on that are determining the sort of rent contours across London right now. Office development, mentioned earlier, is very low. The yellow or the orange here is pre-committed. So you can really, if you're looking at speculative office construction as a potential warning sign in London, you've just got to look at the red. And the red is very, very nominal compared to the long run average. And these big blocks of yellow here are Google and Facebook committing to further major headquarters in London, which are currently under construction. Net supply, you demolish a 100,000 foot building, put back 150,000 feet, you end up with the kind of the net supply figure, and that's very low as well. This is a super long run average going back to the late 1980s when we had the first major correction of our lifetimes, and you can see the blue lines there with net supply being very low. In a normal economy, not sure what you would call the current economic environment around the world, but in a normal economy, those blue lines would point to very strong rental growth. So all things equal, the office market is feeling very positive about the fundamentals as a result of the supply and demand situation. Coming on to the investment market, it's the giant quantitative easing, zero interest rate policy, negative interest rate policy pyramid. You've got $12 trillion worth of sovereign government bonds now currently trading at below a 1% yield to redemption. These alternative avenues of return are terrible and minuscule and uninvestable if you are a liability matching pension fund. You simply cannot afford to have too much of your portfolio in negative yielding or midget interest rates from fixed income. And as a result, allocations to real estate are going up as a result of that. This looks at the disparity between fixed income government bond yields in certain countries and then where prime office cap rates are. And again, you can see the huge gap, the yield gap, which is forcing capital into the real estate market. London is still very attractive by all the metrics that you look at there relative to fixed income. Volume in London, it's about 16 to 20 billion pounds a year investment market. So it's liquid. International capital, which is the grey bar there, still makes up the majority of capital into London. That's not necessarily saying that UK investors are not bullish and it's only overseas money coming in. What it is really saying is overseas capital, the giant sovereign wealth funds, the big Canadian pension plans, Blackstone, Brookfield, and other overseas investors are just far larger now than even the UK institutions and the UK REITs. I think the largest REIT in the UK is barely in the world's top 50 now. By size, by equity market cap. So it's a size thing as opposed to a local investor sentiment thing when you look at that large overseas share. There are some very, very big bets on London being made by investors. 7 transactions at over £1 billion each, which you can see there, and 5 out of 7 were made by Asian investors. I won't dwell on this. This is the carry trade math. Very simply, if I was making an advertisement for London, I would say to someone, the Italian 10-year bond is currently priced at 2.6%. You can generate that return and then some from owning an Italian store on Bond Street. So would you rather have Italian bonds, or would you rather have an Italian store on Bond Street? The Bond Street asset is going to yield a significantly higher return. The REITs in London are fairly priced. They're either side of NAV, but the wider sector in the UK, the REIT sector, is trading off quite substantially as a result of retail woes. Trends in the London office market. First one is for the first time ever, you've got 4 generations all in the market at the same time. Baby boomers, Gen Xers, millennials, and the I generation, all competing for jobs at the same time. That's a very important trend, and it relates, and Ollie was talking about it earlier, in terms of how you position buildings to appeal. Co-working, we discussed, is obviously another very big trend. Thank you, Yemi. Crossrail, transport infrastructure, again, is going to be a very significant driver for growth in London. And finally, the creative workforce and the implications that has on buildings and how they are managed and operated. I'll try and summarize Brockton very simply in a few slides. Brockton Everlast is a new firm, capitalized last year with capital from Alony Hetz and from the management team. We now have 100% focus on acquiring large London office buildings, but our history, as Abby was explaining earlier, spans around 14 years across 20 million square feet and over £5 billion worth of assets. This is where our capital has come from historically. The Alony Hetz is in this element of the pie chart, and we've raised just under £2 billion historically over the last 14 years. But going forward into Brockton Everlast, we are all about investing into London. I probably won't run through the case studies in the interest of time, but I'll come on to the strategy for Brockton Everlast. The goal over the next 5 to 7 years is to create a portfolio of around £3.5 billion, supported by between £1 billion and £1.5 billion of equity. Just to be clear, we don't anticipate that all coming from Alony Hetz. Alony Hetz have committed an initial £350 million into the platform, and it is likely that they will be joined over the next few years by other major institutional investors coming in alongside them, perhaps more akin to Car Properties' current ownership structure. The Brockton team is fully integrated. It's a 26-person team spread across these 8 divisions, and we all sit in a single office in London and think of ourselves as a soup to nuts investor, developer, asset manager. The 3 buildings that we've acquired are all in 3 separate submarkets. In summary, there's just under £20 million of gross rent roll across these 3 buildings. They total just under 500,000 square feet with 98% occupancy, 7.5 years of average income, and all characterized by day one income, what we think is a very, very acceptable return on equity on a levered basis of around 8.5%, and all 3 of them with development optionality at certain stages in the 2020s. And these are the 3 buildings that we've acquired. On the left, a building on the edge of the financial district and the edge of the edge of the Spitalfields and Shoreditch Tech District. In the middle, the building is the headquarters of the London Fire Brigade, so essentially a quasi-government credit. And on the right is a building in Paddington, which is the global headquarters of Marks & Spencer. And all 3 assets are characterized, as I said, by having day one income, about an 8.5% return on equity on a levered basis, with development optionality at various moments over the next 10 years, which we see tremendous value in having that optionality with the income to pick our moment in order to execute a higher return strategy. Brockton's point of difference is we're always looking at assets and in the market from a different perspective, and there's an intense work rate from the team as we try to generate positive returns for all the investors. That's where we sit in our competitive set compared to the institutions, sovereign wealth funds, ultra high net worth investors, REITs, the big killer bees, Blackstone and Brookfield. And you can see here we have a split across 3 strategic buckets, being core plus and value add, which is around 60% of the equity will be going into those kind of opportunities, perhaps 20% into more opportunistic investments into emerging neighborhoods, and then 20% in development. And finally, just that we take a long run perspective on London and think about London in the long run context, where it has been a major global city for over 500 years. And we are taking a medium-term view as to seeing through the Brexit volatility to the fundamentals that still exist in our city. Thank you very much.